Welcome to Central Bank Central. I'm Kathleen Hayes. So we kick off this week with the latest National Association for Business economic outlook, inflation outlook. What's the Fed going to do next? Outlook, all kinds of things in this 60-year-old survey. And in fact, the headline today for them, expecting mildly stronger growth, marginally higher inflation pressures in 2026, and the Fed yet expected to cut rates in December. So I am very happy to welcome to Central Bank Central for the very first time, Yelena Maleyev. She is a senior economist at KPMG in Chicago, and she's also the survey chair this year for the NABE. So it's great to have you.
Thank you for having me. It's a pleasure to be here.
Well, first of all, it I think let's talk a little bit about the survey because I say the headline, I'm going, okay, you've got milder growth, excuse me, you got stronger growth coming. You got inflation even higher, farther above target, and yet the consensus at least of the members of the NABE, a rate cut in December. I want to get deeper into that because someone might say, well, why are they saying that? What's the need to move? So let's talk a little bit about the survey. It's been done for 60 years. How many people participate? When and how do you accumulate the data to give us some sense of, again, not just what's in there, but the fact that this has a history.
Definitely, thank you. So the survey consists of 42 professional forecasters responding on a quarterly basis, and as you mentioned, for 60 years now. This particular survey that we're going to be discussing was conducted from November 3rd to 11th. So as our viewers can recall, that there was a government shutdown during that time. We weren't receiving any economic data. So the last economic data points that we actually received between this survey and the prior survey that we conducted was really just second quarter GDP, PCE, inflation and personal consumption data, and then a few smaller indicators as well. And so we didn't really have a lot to work with, but we did have the private sector data that did come during this time. And then, of course, the government officially reopened November 12th, the day after we finished collections.
Suppose if your members get a certain amount of sort of anecdotal or at work kind of information because this is business economics and business economists. So presumably that's one of the things that they bring to this survey that some other surveys might not.
Exactly, because forecasting any sort of analysis during a time of high uncertainty is a lot more of an art than a science. So, of course, the fact that we have these professional forecasters that have been doing this for a very long time really elevates the forecasts and our ability to kind of see through times of missing data or delayed data.
Let's start from the top then, I guess, because you do see modestly stronger economic trajectory compared to that in your October 25th survey. And you are looking at inflation to be even higher. The target's 2%. You're expecting it just below 3%. That's the consensus. So why does the Fed need to cut rates? What is the sense you're getting both from the survey data, but also the conversations?
Yeah, so the forecast for inflation for next year was marked up slightly to that 2.6%. But however, inflation for the end of this year, which is when we do expect that extra rate cut from the panel, that was actually a little bit flatter, a little bit lower than expected in the October results. So with that expectation that inflation wasn't going to be as hot as the last survey showed, essentially panelists moved up an extra rate cut. So instead of having 75 basis points next year and 50 this year, they have flipped that to 75 this year and 50 next year, with that inflation coming down a little bit this year and not as fast for next year. So it's a little bit of a flattening, if you will, in the curve.
Okay. And of course, you do have the core PCE up to 2.9%, which is certainly the one that the Fed watches most closely. Again, just about 3%. Um, how about the GDP figure? Is it supposed to be weak enough, flat enough that that's going to make you think, not so much upward pressure, more room for inflation to come down, more room for the Fed to go ahead and do this rate cut? I would put it this way, if not in December, maybe shortly after the first of the year.
Right. So what was really interesting about this survey, as I mentioned, we did not receive Q3 GDP when we were supposed to when this was conducted. panelists marked up their third and fourth quarter GDP figures to end the year at 2% growth rate, which is higher than we had last time the survey was conducted. But however, so this was driven by growth in the consumer as well as some investment. But at the same time, third and fourth quarter inflation was marked slightly lower. So this kind of expectation for stronger consumption and stronger investment did not translate to stronger inflation, which was very fascinating in the results. And then, of course, for next year, that inflation then comes a bit later into the end of next year. So GDP 2% year on year, still a fairly strong economy, of course, driven by the consumer, driven by investment. Is that sustainable? Of course, the next year's GDP number shows to be 1.8, according to the panelists. So not quite two, but clearly not a recession in the expectations of the median forecast. However, I think the concerns are more around the labor market and the break-even jobs numbers, and therefore panelists decide to kind of switch the Fed cut to December rather than sometime next year.
Well, there's so many economists though who've said the natural rate of payrolls growth and is probably 50,000 a month. Maybe some say 20 or 30,000. How much weight can NABE members put on the payrolls numbers? And unemployment is still going to be, even if with a small rise you're forecasting, it's still what many would consider a pretty sweet spot, right? 4.5%
Right.
or less. So again, and when we listen to Fed officials speaking lately, there's many of them who say, don't need to cut now because these things are so uncertain. You have to, and it doesn't hurt. Nothing's
Mhm.
going to run away from you if you don't cut now.
Right, and we're going to see this ongoing dissents from the Federal Reserve future meetings, simply because there are the kind of the two camps, right? That are the ones that are more worried about inflation versus the ones that are more worried about the labor market. In this survey, we specifically asked the special question we've been asking for a little while now: what is the break-even rate of monthly payrolls that will keep the unemployment rate steady? So this survey, we actually have majority of panelists, about 45%, believe that it's between 25,000 and 50,000. And so, of course, we have a delay. We just finally got the September numbers. We do have a delay for October, maybe even November, coming from the BLS. So the Fed's not going to have those numbers in time for their meeting in December. But it's really interesting that the panelists revised also their expectations higher for 50 to 75,000. So there seems to be, as long as majority of panelists are kind of below that $100,000 payroll threshold, which is very, very interesting. And then, of course, the actual forecast for payrolls for fourth quarter is actually 23,000 monthly average, so significantly below what many believe to
Yeah.
be
Well,
break
that
even.
was certainly a good question to add to your survey, right? Because everyone, is still talking about that consistently now, right? Um,
Exactly.
in terms of there's tailwinds and there's headwinds. Seems to me a lot of people are looking at with this flat GDP forecast, you could say, okay, but isn't there a huge slug of investment on AI, on data centers, which certainly feeds into construction, other jobs in the economy? There's talk now of rebate checks from tariffs. You know how
Mhm.
people go back to COVID, you know how people love to get checks in the mail. Um, it seems that the NABE consensus is kind of downplaying the tailwinds. What do you see there in the survey and the things that people are saying?
It does seem to be that the baseline forecast that we heard from the panelists does perhaps downplay that, but we did ask another question we've been asking for a long time, which is what is the greatest upside risk to the US economy, considering occurrence and potential impact? And continuously, panelists seem to be responding with stronger productivity growth. So if forecasts are marked higher, a lot of that could come from the stronger productivity growth that does usually stem from this investment, especially in AI, technology, labor enhancing kind of productivity. However, a majority of the panelists still believe that the risks are balanced to the downside. So the downside risks do still seem to have a lot larger weight in panelists' forecasts than this upside productivity surprise.
Let's talk a little bit more about inflation and why the survey sees inflation dropping from just about 3%, as we just said, through early next year to 2.25%, 2.4%. That's what I'm trying to say by the end of next year. And that's would be despite a further 25 basis cut in the Fed funds right now, and then another 75 basis point cut next year. So with less monetary restrictiveness, by a good bit, you could say, with tariff pressures, and a good deal of fiscal thrust, and then we're always seeing more reports that those tax cuts, other things are having an impact. Um, why then would you expect inflation to, or why do your members expect inflation to actually retreat again in the face of potentially more stimulus and actually more reasons why you might see that tariff push through continue in 2026?
Well, I think on the monetary side of things, they do not see Federal Reserve policy to be stimulative next year. So even with an expectation of one more cut this year and two more next year, panelists do believe that the neutral Fed funds rate, majority of panelists believe it is at 3%. So that does leave us slightly above what neutral is, which could be considered still in the restrictive territory. So it's not that monetary policy will become stimulative all of a sudden. On the fiscal impulse side, we didn't have any special questions on that, unfortunately. But when it comes to just general inflation expectations from things like tariffs, panelists did seem to mark down their expectations of the impact of tariffs on inflation. They still, on net, believe tariffs will be slightly inflationary. One of the special questions was, what is the cumulative impact of tariffs on personal consumption expenditures by next year, by the end of next year? And majority of panelists believe it's about a quarter to a half of a percentage point cumulative impact. But they also expect that these tariffs and price pressures will also have a downward impact on growth, which is the same kind of conversation Federal Reserve officials are having, right? Which is going to be the more important signal, still high inflation or slowing growth? And panelists do believe that cumulative impact of tariffs by year end 2026 will have a downward impact of about also a quarter to a half of a percentage point. So it's just a
That,
matter of these expectations coming true or not. But the Federal Reserve policy is not expected to be stimulative, if you will.
okay. Speaking of uh, the trade, that's what I'm trying, trade and prices. The nominal trade deficit gets wider in 2026. Is this a fundamental force, or is it more like a J-curve effect? Sort of like because tariffs first drive up prices before people actually start reacting to them and to higher prices by buying less. What do I don't know if you asked anything that detailed, but I'm just curious what you got from the survey.
Yeah, the most detail we have is really just the expectation of growth of exports compared to the growth of imports. And it's just that the growth in exports is slower than the growth in imports, hence increasing the trade deficit slightly. But of course, as we get more announcements about tariffs, we could add newer questions to make sure we understand kind of the implications of some of these new trade and tariff policies. But for the time being, it really does seem to hit more on the export side than the slowing the imports.
And what about that look for bonds, for treasury yields, et cetera, remaining little changed? Is it because of its credibility as an inflation fighter, or even though it's been missing its target for nearly 5 years now? Is it because the administration is not really issuing too many net new long-term securities and then helping to support the outlook for longer term yields? I wish I could get inside more of the brains, right? Because put them behind you on the but just in terms of what people are thinking, because I know you get what with over 40 people, you're not getting everybody with the same view.
Correct. Yeah. And we do have a question about fiscal deficits. So they will remain growing fiscal year over fiscal year. And that does push up longer term yields, of course. That's the most detail that we'll get on, kind of expectations for the government
Sure.
budget. But of course, I think with all of the concerns about demographics and Federal Reserve policy, and again, as I mentioned, the risks do remain to the downside for the overall economy rather than the upside. I believe that the panelists were kind of keeping that in mind when responding to this. But as you mentioned, the expectations for the 10-year were very little changed from the last survey. So obviously there's a lot of uncertainty around, especially the long end of the yield curve.
So, I'm also curious, what about the skew? I mean, you come up with an average. I'm just curious, what did you hear from the opposite end? One, oh my gosh, Fed's not going to cut, or inflation's still a problem, versus those who maybe even thought there'd be more cuts, or that think that the time not only is right but needed for the Fed to do more cuts. Can you tell us more about that? What you heard from the two ends when you got all these responses?
Definitely. So we do have in our PDF file, you can see not just the sample median, but also the five lowest and the five highest to kind of compare ranges. So for example, the federal funds rate by the end of this year, the sample median and the lowest were about the same, expected one more rate cut. And then the five highest actually expected no more rate cuts, which was interesting. But then when you look at the end of next year, the five lowest expected 2% Fed funds rate. So that is stimulative rather than the five highest, which expected maybe one more rate cut. So wide dispersion and expectations for what the Fed is going to do. Same goes for the labor market. We have a huge dispersion in what people think non-farm employment average monthly payroll change will be. So some folks by the end of this year expect payrolls to turn negative at negative 77,000. Others expect it to be near 100,000 at the five highest. And then for next year, the dispersion is just as wide. We have nearly zero, about 18,000 payroll growth per month by the end of next year compared to 145,000. And unfortunately, we cannot map which payroll matches which Fed funds expectation, but that does give you a good idea of just how widely dispersed some of these views and forecasts are.
So it's certainly an interesting survey, and shows a lot about what other people are expecting. Do you have any sense? I guess this is my last question. Do you have any sense when people talk about what the Fed's going to do or what they expect, to what extent they're basing it on, here's my analysis of inflation, here's my analysis of unemployment, all these other things, and how much they're basing it on, hey, I've been listening to the Fed. I know what the message is. I'm looking at what they say the neutral rate is, because if John Williams, third in line at the Federal Reserve, said this is it, a lot of people want to say, well, maybe I got a different calculation, but that's what John Williams says, right?
Mm.
The man who just about invented neutral rates in our star. But what can you tell me about that? And of course, you've done this survey before, and you know a lot of people who are in this organization. How do you think that how does that suss out?
Yeah, we do try to suss out some of that by asking those special questions like, what do you think the neutral Fed funds rate is? Majority of panelists do think it's 3%, similar to some folks at the Fed. We do ask when they think the Federal Reserve will hit this neutral rate, which majority believe is in the second half of next year. So we do try to get some of the art part of forecasting in these special questions. But unfortunately, when folks mark down their baseline forecasts, they're not telling us how much of it is based on a model versus their own lived experience or anecdotal insights. But that's what makes it so great to ask these professional forecasters, because they do have so much experience and so much knowledge
Okay.
that is in the wisdom of crowds, especially with this group, definitely.
So I guess this is really my last question. What do you see? What do you think the Fed's going to do or not do? What are you looking at for just, we're in a way just days away from the big meeting, the last one of 2025. What do you see?
Our team does expect another rate cut this year, a 25 basis point cut in December. Now, a lot of that is still whether that will happen is still a concern, simply because we don't have enough data yet for the third quarter, simply because of the government shutdown and the lags in how long some of these data get released. But of course, we do have a lot of more dovish signals from Federal Reserve officials in recent weeks. We do think that policy is still in restrictive territory, and concerns about the labor market are, of course, becoming louder and louder. Therefore, we do still have one more rate cut for this year in our forecast.
Well, all right. I'm so glad you joined us. Took
Thank
some
you so
time out
much.
from a very busy day here on Central Bank Central to talk about the National Association for Business Economics Outlook. If somebody, where would you tell somebody to find it? Just Google NABE and you'll find it right there.
Go to NABE.com. It's right on the front page. We have a webinar accommodating that Outlook released as well. And so there's many ways to kind of get informed about the latest survey.
Okay. Well, thank you again.
Thank you,
That's
Kathleen.
Yelena Maleyev, and she is both the survey chair for the National Association for Business Economics and she's senior economist at KPMG. I'm Kathleen Hayes, and this is Central Bank Central.